Hey there, Mad Money viewers. Welcome back to another exciting episode where we break down the complex world of finance into bite-sized, easy-to-understand pieces. Today we're diving into the world of investing, specifically looking at two popular options, stocks and mutual funds. These are fundamental concepts that every investor should understand. You hear me talk about them all the time, but what are they really? Let's demystify these terms and see what they mean for you as an investor. In simple terms, a stock is like owning a tiny piece of a big company like Apple or Tesla. When you buy a stock, you're essentially buying a small share of that company. When the company does well, your stock value goes up. This means your investment grows and you can potentially make a profit. Mutual funds, on the other hand, are like baskets holding a mix of different stocks or other investments. They pool money from many investors to buy a diversified portfolio. Think of it this way. Buying a stock is like betting on a single horse in a race. You pick one company and hope it performs well. You could win big, but there's also a higher risk. If that company doesn't do well, your investment could lose value. Mutual funds are like betting on the entire field. By investing in a variety of stocks, you spread out the risk. It's more diversified, potentially offering a smoother ride. This means that even if one stock doesn't perform well, others in the fund might balance it out. So which one's right for you? It depends on your risk tolerance, investment goals, and how much time you want to spend managing your investments. Let's break it down, Mad Money style. Stay tuned as we explore these options in more detail and help you make informed investment decisions. Let's start with stocks. They're like the building blocks of the investment world. When you buy a stock, you're buying a small ownership stake in a company. That makes you a shareholder. Being a shareholder comes with certain rights, like voting on company decisions. More importantly, you get to participate in the company's growth or decline. If the company's profits soar and its future looks bright, the stock price generally goes up. That means your investment grows. But if the company struggles, the stock price may fall, and you could lose money. Remember, stocks can be volatile. They can go up and down quickly, sometimes making your stomach churn. But hey, that's the stock market for you. Now let's talk about mutual funds. They're a bit different. Instead of buying individual stocks, you're buying into a professionally managed portfolio of various investments. Think of a mutual fund as a big basket. Inside this basket, you'll find a mix of stocks, bonds, or other assets. This mix is chosen by a fund manager whose job is to try and make your money grow. The beauty of mutual funds is diversification. By owning a small piece of many different investments, you're spreading your risk. It's like not putting all your eggs in one basket. Mutual funds are a popular choice for investors who want professional management and diversification without having to pick individual stocks. One of the biggest advantages of mutual funds is diversification. Remember that basket analogy? Well, imagine that basket filled with apples, oranges, bananas, and grapes. That's what a diversified mutual fund looks like. It holds a variety of different investments, spreading your risk across different companies, industries, and even countries. Why is this important? Because if one investment goes sour, the others can help cushion the blow. It's like having a safety net for your portfolio. With individual stocks, you're putting all your eggs in one basket. If that company falters, your investment takes a direct hit. Mutual funds, with their built-in diversification, offer a smoother ride. Section 5. Professional management, another plus for mutual funds. Another advantage of mutual funds? Professional management. When you invest in a mutual fund, you're basically hiring a team of experts to manage your money. These fund managers spend their days researching companies, analyzing market trends, and making investment decisions. They aim to maximize returns while managing risk. Now, I know what you're thinking, but Jim, can't I just pick my own stocks? Sure you can. But it takes time, research, and a certain level of market knowledge. Mutual funds offer a hands-off approach. You're trusting the pros to handle the heavy lifting while you sit back and hopefully watch your money grow. Section 6. Liquidity, a shared strength. Both stocks and mutual funds share a key advantage: liquidity. This means that they can be easily converted into cash without significantly affecting their market value. Liquidity refers to how easily you can buy or sell an investment without affecting its price. It is a crucial factor for investors who may need to access their funds quickly. Stocks, especially those of large, well-known companies, are generally very liquid. These stocks are traded in high volumes, making it easy to find buyers and sellers. You can buy and sell them quickly on stock exchanges like the New York Stock Exchange or Nasdaq. These platforms facilitate the rapid exchange of stocks, ensuring that transactions are completed efficiently. Mutual funds are also quite liquid. They pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. You can buy or sell shares of a mutual fund at the end of each trading day based on its net asset value, NAV. This value is calculated by dividing the total value of the fund's assets by the number of shares outstanding. This liquidity is crucial because it gives you flexibility. Whether you need to reallocate your investments or access cash for an emergency, liquidity ensures you can do so without much hassle. You can access your money relatively quickly if you need it, although remember that market conditions can impact the actual price you buy or sell at. Always consider the current market environment when making investment decisions to ensure you get the best possible outcome. Section 7. Risk and reward. Stocks on the edge. Now let's talk about risk and reward. Stocks are generally considered riskier than mutual funds. Remember, when you buy a single stock, you're betting on the success of one company. If that company hits a home run, your investment can skyrocket, but if it strikes out, you could lose a significant portion of your investment. Mutual funds, with their diversification, tend to be less risky. The ups and downs of individual stocks are balanced out by the performance of the other holdings in the fund. However, lower risk often means lower potential reward. While stocks offer the potential for higher returns, they also come with a higher chance of losses. Section 8. Costs and fees. Mutual funds under scrutiny. One area where mutual funds sometimes get a bad rap is costs and fees. These costs can be a significant factor in the overall performance of your investment. Because they are actively managed, mutual funds come with expense ratios, which are annual fees charged to cover the fund's operating costs. These costs include management fees, administrative fees, and other operational expenses. These fees can eat into your returns over time, so it's essential to pay attention to them. Even a small difference in expense ratios can have a significant impact on your investment's growth over the long term. Look for mutual funds with reasonable expense ratios and a strong track record. A fund with a lower expense ratio and consistent performance can be a better choice for long-term growth. Stocks, on the other hand, generally have lower trading costs. This is because they are not actively managed, and you only pay fees when you buy or sell. You typically pay a commission when you buy or sell stocks, but these fees are usually much lower than mutual fund expense ratios. This can make stocks a more cost-effective option for some investors. However, don't let fees be the only deciding factor. It's important to consider other aspects of the investment as well. Consider the potential returns, risk level, and your overall investment goals when choosing between stocks and mutual funds. Each investment type has its own set of advantages and disadvantages, and the best choice depends on your individual financial situation and objectives. Section 9. Control and customization. Stocks take the lead. When it comes to control and customization, stocks take the lead. When you buy individual stocks, you have complete control over your investment choices. You decide which companies you believe in and want to invest in. You can tailor your portfolio to your specific risk tolerance and financial goals. Mutual funds, while offering diversification and professional management, don't give you this level of control. You're trusting the fund manager to make investment decisions on your behalf. This lack of control can be a drawback for some investors who prefer to be more hands-on with their money and make their own investment choices. Section 10. Real-life examples illustrating the concepts. Let's bring this to life with some examples. Imagine you invest $10,000 in Apple stock. If Apple's stock price increases by 20%, your investment grows to $12,000, a tidy profit. Now imagine you invest that same $10,000 in a mutual fund that holds Apple stock along with stocks of 49 other companies. If the mutual fund's overall value increases by 10%, your investment grows to $11,000. See the difference? The individual stock had the potential for higher returns, but also came with higher risk. The mutual fund offered more moderate returns, but with potentially less volatility. Section 11, conclusion, choosing the right path for you. So which is better, stocks or mutual funds? The answer, my friends, is it depends. Both investment options have their pros and cons. Stocks offer the potential for higher returns, but also come with higher risk. They're a good choice for investors who are comfortable with volatility and have the time and knowledge to research individual companies. Mutual funds provide diversification, professional management, and generally lower risk. They're a solid option for investors who prefer a more hands-off approach or are just starting out. The best choice for you depends on your risk tolerance, investment goals, and time horizon. Consider your individual circumstances and do your research before making any investment decisions.